So now we'll discuss about the corporation tax issues. So first of all, one of the issue is about the residence status of a company. So the rule is that companies resident in UK, if a company is classified as a UK resident company, then the company has to pay corporate tax on worldwide income and gains in UK, irrespective of the company is earning in any other country, but tax has to be paid in UK on UK income as well as the other country's income. So how we can identify a company is UK resident? A company is UK resident if it is either incorporated in UK. If a company is incorporated in UK, it's always a UK resident company. Or if a company is not incorporated in UK, but if it is centrally managed and controlled from UK, for example, a overseas company, but the majority of directors are resident in UK and board meetings are also held in UK, then still we can classify that company as a UK resident company. But if a company is not UK, not incorporated in UK, and board of directors are not held in UK meetings and other things like that, then a non-UK resident company, the rule is that non-UK resident company will pay tax on UK income in UK only. If there is any UK income, then they have to pay tax in UK. So accordingly, the rule is that we have to identify if a company is incorporated in UK, it is UK resident. If it is incorporated overseas, but centrally managed and controlled in UK, then it is UK resident company. But if not, then it's overseas company, not UK resident company. Now, as far as the company's accounting year end and the company's tax year is concerned, so a terminology is called accounting reference date, which is the date for which company prepare accounts, such as, for example, the year end of the company is 31st December 2022. A 12-month period, suppose, started from 1st January 22 to 31st December 22. So we'll say this is the accounting reference date. And as far as the tax year is concerned, it is called accounting period, is the period for which tax can be calculated. And it's also known as chargeable accounting period. So normally we say accounting period is an terminology which is used for accounting purpose, but here accounting period is term used for tax year. So this is basically your tax year. And the tax year starts from 1st April to 31st March. So 1st April 22 to 31st March 23, it's tax year 22. A tax year can be of 12 months. It can be of less than 12 months, but a tax year can never be more than 12 months. Like in the case of an individual business, it can be more than 12 months, but in the case of a corporation, it can never be more than 12 months. So if the accounting reference period is of, suppose, 18 months, then tax year can never be more than 12 months. So we have to split this period into two parts. First one is always a 12-month period, and the next one, which is a short period, 6 months. And remember, the first one must be a 12-month period. Now, as far as the tax rate is concerned, the company's tax rate for the tax year 22-23 is a fixed one, which is 19%. So whatever is the taxable profit company earned during the tax year, we have to apply 19% irrespective of the size and nature of the business, whether it's a large organization or a small one, everyone has to pay tax at 19%. Now, in order to calculate tax, we have to find out the company's taxable total profit. And in the case of company, all source of income, we have to combine into a single pro forma. which is not the case in the case of individual, where non-saving income is separate, saving income is separate, and dividend income is separate, and there is a separate tax rates. But here it is only one single rate for all source of income for a company. And how we can calculate this? This is the layout. This is the pro forma. Suppose we have tax adjusted trading profit of the company, interest income of the company, property income of the company, any other income, which is called miscellaneous, chargeable gain. Remember, chargeable gain is also part of this pro forma. In the case of individual, chargeable gain is separate and income tax is separate. But here, chargeable gain is also in this pro forma. So if we combine all income, this is called profit. There is no dividend here. Why dividend income is not part of this pro forma? Because in the case of the company, if the company is receiving any dividend, it is an exempt income. So it's not part of this pro forma. And if there is any donation paid, which is classified as qualifying charitable donation, then we will deduct this from the total profit in order to arrive at a value which is called taxable total profit. And on this figure, we have to apply a tax rate of 19%. So it's very simplified as compared to the individual. And there is no personal allowance. There is no basic band, higher band, or something else like that. There is no NRB on saving income, and dividend is not taxable. Now, as far as the tax adjusted trading profit is concerned, we have to calculate always on the basis of accrual method. Accrual method is allowed. No cash basis is allowed for the company. So what we need to do, in the same way that we did in tax adjusted trading profit of a sole trader or partnership, from the accounting profit, we have to make some adjustments, but there are few differences. Other rules are quite similar, but there are some differences, like no private element adjustment. In the case of a sole proprietorship, we add private expense of the owner, but there is no private element should be added back. Similarly, drawing is not relevant for the company, and any distribution to shareholder, that is the dividend, are not allowable deduction. It's not an expense, so will not consider in tax adjusted trading profit. Family salaries are also not relevant for companies, like we did in the individual transaction. As far as the legal charges is concerned, the rule is same. Legal fee regarding the issue of share capital are an expense only for companies, as they are of capital nature. The expense is disallowed and added back. But as far as the legal fee with regards to the loan notes, that is an allowable expense. Similarly, legal fee with regard to registration of patents and trademarks are allowed by the tax authority. As far as the interest expense and interest income is concerned, we'll consider interest income always in the main pro forma, and we'll deduct the interest expense against that income in the main pro forma if that interest expense is related to a non-trade loan. If interest expense arises as a result of a trade loan, such as you buy a plant and machinery and you took out a loan for that, then it's a loan for trading purpose. So as far as interest payable on a non-trading loan, if it is deducted from the profit and loss account, then what we need to do, we have to add it back, and then we have to deduct that expense from the interest income from the main pro forma. Another difference in terms of capital allowances. Normally, in the case of individual, we have capital allowances available, which is AIA, which is first year allowance on motor car. Similarly, we have WDA for main pool. It is journal pool and main pool, it is 18%. And for special pool, this is 6%. All the criteria are same. But in the case of company, there is no such private column. No such private column in the case of company. Plus, there are some additional benefits. This is called enhanced capital allowances for companies. In the case of a plant and machinery, which is a part of main pool item, we can deduct super deduction of 130%. What it means? For example, the cost of my asset is supposed to be 800,000. Then I can claim super deduction, which is 130%, that is 800,000 into 1.3. And I can deduct this amount from my capital allowance computation. So it's 800 into 1.3, 1040. Now you have a choice whether to opt for AIA or for super deduction. So we'll always go for super deduction rather AIA in case of a main pool item. And remember that this super deduction is only available for against a new asset, not against the old asset. So if a new asset is acquired, then we can claim super deduction rather than AIA. We cannot get both in against the main pool. Now, as far as the special rate pool is concerned, so if we have AIA available for a special rate pool item, then first we will claim AIA, and on the remaining balance, there is another benefit which is called the first year allowance, which is 50%. Suppose we have purchased a special pool item that is cost us 1.5 million. Now, first we will claim AIA up to 1 million. Remaining balance is 500,000. Then we will claim 50% allowance, which is 2,50,000. And now the remaining balance is 2,50,000. But if we are claiming 50% special rate allowance, in that year, we cannot claim the WDA. So we have to keep an eye on this because this is different from the individual business where super deduction in a special rate pool first year allowance is not applicable. So for expenditure which would fall into the main pool, there is a 130% super deduction. This means that for every 100 of expenditure, a first year allowance of 130 is available. Means more than the amount incurred by the business. For expenditure which would fall into a special rate pool, there is a 50% first year allowance. For expenditure falling into the main pool, the 130% super deduction should be claimed rather than 100% annual investment allowance. However, for expenditure falling into the special pool, the 100% annual investment allowance should be claimed in preference to 50% first year allowance. For example, H Limited has an accounting reference date of 31st March each year. On 1st April 21, the tax written down value is 0. During the year ended March, H Limited purchased a new equipment for 1650, of which 3,50,000 is the main pool item and 1.3 million is a special rate pool expenditure. Calculate capital allowances. So for the main pool item, which is 3,50,000, will claim super deduction. So as a result, my allowance is 1.3. So it's 3,50,000 into 1.3, 4,55,000 of allowance against main pool item. Now, as far as the special pool item is concerned, its value is 1.3 million. Now, my AIA is available up to 1 million, remaining 300,000 left, and 50% allowance, which is 1,50,000, and the remaining balance is part of pool. So total allowance is 1 million, 1 million plus 150. So it's 1150. This is allowance for spatial pool, and this is allowance for journal pool. As far as the other things are concerned, all other things are same. For example, short life asset, for example, small pool WDA, for example, balancing charge, balancing allowance, the last year working, everything is same. So the difference we need to keep in account. The complicated rules for unincorporated business, such as sole trader and partnerships, are not relevant for companies. Tax adjusted trading profit is calculated for an accounting period and included within other income and gains to arrive at taxable total profit. The tax is then calculated as per accounting period. So no basis period calculation is needed here. Now, as far as the property income rule is concerned, there are also some differences. Like in the case of individual, we have accrual basis as well as cash basis. But in the case of company, there is only one method is available on accrual basis. And it's relevant with the accounting period. That means property income is also, we have to consider from 6th April to 5th April as per the accounting period. Now, as far as the interest rule is concerned, it's quite different. If interest is payable on a loan to buy a rental property, is deductible against interest income in the main pro forma, rather than it is to be deducted from the property income. There is no rent a room relief for companies. If a company makes a property loss, it must be offset against total profit rather than the income from the same business, which was the rule in the case of the individual business. Interest income rule is quite different. Interest income in the case of company is always part of main pool, and whatever is the interest income, will consider that interest income always as non-trading in nature. So that's why it's always part of main, it's always part of main pro forma. We have to consider this in the main pro forma. Whatever interest is received by the company is all gross, and interest payable is deducted against tax adjusted trading profit if loan used for trading purpose, that is acquire property, plant and equipment to be used in the trade or to increase working capital. If the loan is used for non-trading purpose, then it is deductible against interest income in the main pro forma, and interest, whether it is an income or expense, always be relieved on an accrual basis. Accrual basis is to be used. As far as the qualifying charitable donation is concerned, if we have like donation which is local, given to local charity, and reasonable amount, and conspicuous advertisement is there, then this is an allowed expense. But if it is given to a national charity or international charity, or it's not reasonable, then it is to be added back and disallowed. Whatever is the disallowed donation, we have to consider this as QCD in the main pro forma. And from the total profit, we have to deduct QCD. For companies to ensure tax relief is achieved on their charitable donation, they should make such payment under the qualifying charitable donation. The payment is gross and deductible on a paid basis. This is in the adjustment of trading profit. Any such payment should be added back. If QCD is deducted from the accounting profit, then what we need to do, we have to add it back, and instead it is to be claimed as a separate deduction from the main pro forma. Dividend received from UK and overseas companies are never part of taxable total profit calculation. And what is the reason behind that? It means it is an exempt income. Now, if we have a long period of account, what we need to do? We have to split this long period of account into two periods, first 12 months and then the remaining months. So suppose my accounting reference date started from 1st April 22 to 30th June 23, and it's of 15 months. Then I will split this into two parts. First one is always a 12-month period to 31st March 23. This is first 12 month. And then the next one is April 23 to 30th June 23, a short period. So how that's affect my income, capital allowances, property, and other things. So in order to split this, we have to split their value as well. So as far as the adjusted profit is concerned, before capital allowances, tax adjusted trading profit, first we will calculate before capital allowances, and then we will use time apportionment for the first 12 months and then for the remaining months. Suppose, for example, my tax adjusted trading profit is suppose 1.2 million before capital allowances. So I have to split it like 12 by 15 and 3 by 15. As far as the capital allowances are concerned, so we have to show a separate computation for each accounting period. Suppose if any asset purchased or any asset sold is in first 12 months, we have to consider that is in first 12-month period and then the rest one. And remember that capital allowance calculation is affected by a short accounting period. AIA is time apportioned as well as WDA of 18% and 6%. As far as property income is concerned, we will calculate property income profit and then split this on the basis of accrual basis. And if accrual basis is not available, then the time apportion method is suitable. And normally we did this time apportion like we did in adjusted profit. For interest calculation, we'll always use accrual basis. And for QCD, the relevant date of payment. If QCD is in first 12 month, if donation paid is in first 12 month, we will consider this as first 12 month, otherwise in the next period. And the same is chargeable gain. If an asset is disposed of in the first 12 month, then we will consider that as in first 12 month. Remember for chargeable gain calculation that if there is any gain, suppose 30,000, and in the same period, if we have loss more than that, and it's overall loss of 10,000, then we will not show loss in the main pro forma. And always remember that the loss and gain are offset with each other. So we'll not offset capital loss with any other sort of income available in the main pro forma. So as far as the differences are concerned, in the case of an individual business, we normally identify separate types of income as non-saving income, saving income, and dividend income, and then apply different rates on the basis of basic rate band, the higher rate band, and additional rate band. We have to calculate personal allowances, and there are lots of differences. And if the accounting period is of in the case of a started period of the business, then we have to apply basis period. In the case of cessation of the business, we have to apply basis period. For capital allowances, we have to do some private use adjustment. So there are lots of differences as compared to the sole trader and company. In the case of company, as we discussed, that cash basis is not allowed. Everywhere we have to use the accrual basis.